Hello, everybody, and welcome to our lecture on the monetary system. In this lecture, we're going to define money and describe its role. We're going to describe the role of the central bank. Explain how commercial banks are able to create money. So this is shown with a calculation known as the deposit multiplier, as well as the money multiplier. So what is money? Money is something that came about in order to exchange goods and services more easily. So we could exchange our goods and services using the barter system. This is where I trade one of my goods for one of your goods. Now, the problem with the barter system is that it requires a double coincidence of wants, or a double coincidence of needs. I guess it depends how badly you want or need something. But what this double coincidence is saying is that if I'm trying to get rid of something specific, let's say an apple, I need to find somebody who wants that apple. And similarly, that individual who wants the apple needs to give me something that I want. Well, maybe I'd like a banana, but all this individual has is an orange. Then there's not going to be a trade, i.e. there is not a double coincidence of wants. So I need to find somebody who wants an apple and also who wants to give up a banana. That is a double coincidence of wants. Ultimately, it's just a coincidence that we ran into each other. So money alleviates this issue. Money becomes a numeraire good. A numeraire good. And when we look at the units of measurement for prices, we see that the dollars sign, or the yen sign, or the rupee sign, is in the numerator. Dollars per apple. Dollars is the numerator. It is the numeraire good. Rupees per banana. Rupees is the numerator. It is the numeraire good. Ultimately, money can be exchanged for everything. Therefore, if I want to sell my apple, I can sell my apple to anybody. And then I can go to somebody else who sells bananas and I can buy their banana, even if they don't want apples, because they do accept money. So money gets rid of that double coincidence of wants, or does not require, more precisely, does not require that double coincidence of wants. Money has three functions. The most important is what we just discussed, the medium of exchange. We can exchange any good or service using money. So that's its primary, most important role. The other thing that we would like money to do is store value. Meaning that if I can purchase some good today with my money, let's say if I took all of the money out of my pocket right now and I can purchase 100 apples, then if I kept that money in my pocket for a year, next year I should be able to buy 100 apples. Now we know that this isn't exactly true because of inflation, but if inflation is relatively low, then money serves as a fairly good store of value. If we keep that money in the bank, then the interest rate that we get for our money, that nominal interest rate, will also keep the value of that money above, or keep the value of that money stored, because the interest rate will include the inflation rate. And it is a unit of account, meaning that we can use it to measure anything that we can account for. So we have prices, dollars per apple, dollars per orange. And we can actually calculate the relative price of those goods. Interestingly, we find that the relative prices are fairly constant over time. We can also use it for IOUs. Hey, what do you owe me? You owe me $100. So we have these three functions of money. We have two types of money in society. The first is called commodity money. Commodity money has intrinsic value. So essentially, it is not just good for money. It can be used for other things. It's got value in and of itself. So shells can be used for multiple things. Shells have served as money, but we can also use them for jewelry. Make some necklaces out of a shell. We can use big shells for bowls. We can use shells for cutting tools and scraping tools. Those are intrinsic values. Salt was used as money. Salt was once called, or was called in the Roman times, salar. Salar is where the word salary comes from. So people used to get bags of salt as pay. But of course, salt can be used for other things. Salt can be used for preserving food. It can be used to disinfect wounds. If you rub it on your wound, it actually can disinfect that wound. You can use it to season food, make it taste better. So, salt has values other than just as money. And of course, gold, same thing. We use it for jewelry. We use it in electronics. So gold has money. Gold has value, which is beyond just a use as money. And then we have fiat money. Fiat money is something that the government sets up, and the people accept that money as being worth something. So it kind of requires two sides. Usually the government, has most of the power in that sense. The government says, hey, these are our bills. These are our coins. And they have the value that is printed on them. But there is no intrinsic value. Think about the dollar bills that are in your pocket, in your wallet. You can see perhaps that you have a $100 bill and maybe a $50 bill and a $20 bill, a $10 bill, a $5 bill. Interestingly, when we look at these bills, there is no difference between them other than the color and I guess the artist, the art that is on the bill. But they're the same size, they're made from the exact same material. They're quite literally, or virtually, I guess I should say, they're virtually identical. And yet they have different values. So their intrinsic value is actually identical, whatever you think that little piece of paper is worth. However, as money, we accept them as being of different value. So when we talk about liquidity, we're talking about how quickly something can be converted into currency. So the dollar bills in your pocket. How quickly can I take something and convert it into currency? That tells me how liquid something is. You could also think about it as how readily will this particular good be accepted as money. So that's also going to give you a sense of liquidity. This is also something you might have heard when businesses have what they call liquidation sales. Right? They need to liquidate. It means that they need to sell a bunch of stuff so that they have cash. Right? So liquidity is something that we actually hear on a regular basis. What does it mean? It means, how quickly can it be turned into cash? So money can be grouped into multiple categories. It's essentially called this M system. So we have M1, M2, M3, M4, M5, M6, M7, M8, M9. So if you really get into the definition of money, it does go up. I've seen in some textbooks all the way up to M9. And each of these categories includes the prior category. So, M1 is your lowest category. So M2 includes M1. Plus, it has a couple other types of money in it. M3 will include the M2, as well as a couple other categories of money. So the lower the category, the lower the number, the more liquid is the money within that category. So we see here M1 plus. So M1 plus is essentially currency plus demand deposits. M1 would be just currency. Demand deposits are those deposit accounts that you have in which you can withdraw and deposit money on a regular basis without any real penalty. It's what you can get on a demand. If I go into the bank and say, give me my money out of my account, then they have to give it to you because you've demanded it. This is different than a savings account. Right? Usually when you have money in a savings account, you're not actually thinking about withdrawing that money soon. Right? It's not an account that you use for your day-to-day operations. But a demand deposit account is. So here we have essentially our levels of money that we need to know about. So here we have M1 plus, currency in Canada, and checkable deposits, also known as demand deposits. These are very liquid because essentially they are money that is right there. It's easy to get out. It's easy to pay for things using either of these. And then when we go to M2, well, it of course is going to include the M1 categories there, the M1 monies. And it also includes non-personal demand and notice deposits. Right? So essentially, we could put this into the savings account level of things where you can't just get your money immediately. All right. So there's usually a penalty associated with withdrawing your money from a savings account. There might be a delay. We could think about higher forms of money, or at least higher numbers on our M scale. So a GIC, a guaranteed interest certificate, or a term deposit. Those are similar, meaning that you're giving the bank money that you are not going to get back for some term, right? It could be a 1-year term, which means that if I get a 1-year term deposit, maybe it's for $1,000, I give the bank $1,000, and in 1 year, they're going to give me my $1,000 back, plus interest. If I take my money out of that term deposit before the 1 year is up, then I'm going to incur some sort of penalty for doing it, right? So they'll charge me a fee for taking out that money. And in addition to that, it might take 2, 3, 5, 7 business days before that money is actually in my hands. Notice how long it takes to convert that term deposit into currency. That's why it is not as liquid as currency. And of course, that's why it is a higher number on the M scale. Technically speaking, a piece of artwork could be money because you can ultimately convert that into cash. You can convert it into cash by selling it. That's not very liquid at all, right? So that would be way up there on the M scale, right? But technically, everything's money. How liquid is it? Well, that's what the M scale tells us. What we need to know for this course is M1. And if you know M1, then you know what is not included in M1. But essentially, if you know M1, you'll be fine for this course. Let's talk about how money is created by the Bank of Canada. The Bank of Canada has 4 main functions. So they issue the currency. So they're in charge of the actual currency, the dollar bills and the coins that are in your wallet. They send it out into the system, out into the economy, and they also take old bills that might be destroyed or damaged in some way, and they replace them with new bills. Right. So you'll notice that in Canada, especially, the bills are often changing. Right, so there's a new $10 bill out. Oh, there's a new $20 bill out. And you'll notice that the money generally is fairly crisp, like it looks new. Right, that's because the Bank of Canada is always removing old bills that have been worn out, and replacing them with new bills, keeping that money supply relatively constant. So that is the issuance of currency. All of the commercial banks have bank accounts with the Bank of Canada. So the HSBC, the RBC, Bank of Montreal, Vancity, all of these banks require bank accounts with the Bank of Canada. And that is where they both store their extra money and earn a small amount of interest, and they can also borrow money from the Bank of Canada and pay a very small amount of interest. That amount of interest is known as the bank rate. It is also known as the overnight rate. And the Government of Canada has a bank account with the Bank of Canada. So this is how the government carries out its business through the Bank of Canada. And then the most important aspect that we would be looking at for the Bank of Canada is about controlling the money supply. So it is the Bank of Canada that controls the money supply. They can do this by changing the overnight or bank rate. This again is the interest rate that commercial banks earn on their deposits with the Bank of Canada, or pay when they withdraw or they borrow money from the Bank of Canada. And just like you, if the interest rate that the Bank of Canada is charging, if that interest rate is high, the commercial banks are going to keep money in the central bank. And if that interest rate is low, they're going to withdraw money from that central bank. Right? So This ultimately is going to control the money supply, because if the commercial banks are taking money from the Bank of Canada, then that means that the money supply is increasing. And if they're putting money into the Bank of Canada, then that means that the money supply is decreasing. The Bank of Canada buys and sells bonds. So when they buy a bond, that increases the money supply, and when they sell a bond, that decreases the money supply. Same thing with foreign exchange. When the central bank buys foreign currency, i.e. yen, pounds, rupees, rubles, the Canadian money supply goes up. And when they sell foreign currency, then the Canadian money supply goes down. Notice that the same kind of thing is going on here, just through different mechanisms. So buying something, when the Bank of Canada buys something, Canadian money supply goes up. And when they sell something, Canadian money supply goes down. Quantitative easing. This is about purchasing long-term bonds. This is what was done in the 2008 financial crisis. So what the central banks of Canada and other countries did was purchase bonds from banks at very low interest rates. And these bonds were on the order of 10, 15, sometimes even 20-year bonds. So that is very similar to buying and selling government bonds in its mechanism. However, what's strange about that is that even though these are long-term bonds, the interest rates are very low. That is not usually the case. Usually for a long-term bond, interest rates would be high. So a lot of people consider quantitative easing essentially a bailout, a corporate bailout. And that's why a lot of individuals protested the way that the governments essentially bailed out Wall Street, is the way that a lot of people put it. And then they can change the reserve requirement. The reserve requirement is simply the minimum amount of money that a commercial bank must keep in their vaults. And we'll go over this in a bit. This has to do with the money multiplier. So again, when the central bank buys and sells things, the money supply in the economy will either go up or down. So you've got to, the best way to think about it is, if you're the Bank of Canada, anything that's in the reserves of the Bank of Canada is not out in the economy. So things that the Bank of Canada buys means that they go into the reserves of the Bank of Canada. And of course, they're going to use money, Canadian money, to buy those assets. And that money is going out into the economy. So the money supply in the economy goes up when the Bank of Canada buys something. And vice versa to that, when the Bank of Canada sells something, they're going to sell it for Canadian dollars. Right? So the Bank of Canada sells something, and they get in return Canadian dollars, which means that the Canadian dollars are going into the Bank of Canada, into the reserves of the Bank of Canada, and therefore those dollars are no longer in the economy. So the money supply in the economy has decreased. Buy something, money supply goes up. Sell something, money supply goes down. So one of the things that the government may purchase is one of the things that a central bank may purchase is a government bond. Businesses also use bonds. A bond is simply an IOU. So When you see a bond, it's going to have some sort of face value. This is essentially the principal of the bond. So a face value might be, $100 or $1,000. This is how much that government or business is borrowing. And in return, you get a piece of paper called the bond. And that bond is going to tell you when you can return the bond and get your money back. So there's 1-year bonds, there's 2-year bonds, 5-year bonds, 10-year bonds. Bonds can literally be of any length. The date at which you can get your money back is called the maturity date. That's when you get your principal. That's that face value of the bond. That's when you get that back. Now, along the way, you could possibly sell that bond in the market. Right? So once you own the bond, you don't have to keep it forever. You could sell it. Maybe you just need money. And you're thinking to yourself, well, I've got this bond here. Maybe somebody will buy this bond. Whoever you sell that bond to now has the right to return it at the maturity date to the issuer and get the money back. So ultimately, that bond price can also change. So maybe a company is doing poorly. Well, if you've lent a company $1,000 and you're supposed to get your $1,000 back in let's say 2 years, but this company is starting to do poorly, and there's a very good chance that they're going to go bankrupt soon, then you may want to sell your $1,000 bond at a loss just so you don't lose everything. Right? So you're not going to wait for them to go bankrupt. You might say to somebody, hey, I'll give you this bond for $500. Well, if that company is still around, the person that you sold it to is going to be able to go to that company and get $1,000 because that's the value of the bond, right? But like I say, the price of the bond is going to fluctuate. And essentially, if the price goes down, that means that the yield is going up. And if the price goes up, that means the yield is going down. So the yield is essentially the interest rate or the return on the bond. And like I say, if the price of a bond goes down to $500, well, then that means that the yield is going to be essentially 100% for the bond that we've talked about. Right? Remember, the bond that we're talking about was a $1,000 bond, which means that whoever holds this bond is entitled to get $1,000 when they return it to the issuer, i.e. the person who borrowed the money to begin with. They're entitled to get $1,000 back. So if this bond is selling for $500, then that means that the yield would be 100%. Now with a bond, there is no ownership of the company. So you're not entitled to profits. If the company does really well, you're not entitled to get any extra bonuses. Right? So if you happen to buy a bond from Microsoft back in the 80s, the 1980s, you're not going to get millions of dollars in return for helping that company. They will simply pay you the 10 or 15% that they promised at the beginning. So that is how a bond works. So let's take a look so we can get a better picture of a bond. Here's a bond. This one happens to be a government bond. And we can see that it is a $100 bond. Right? So fairly clear. It says that everywhere. Fairly old bond by the looks of it. It's a paper bond. And what we can see on this is, well, all of the things that we care about, we just talked about. Right? So we see the value of the bond. over here on the right, $100. It is a $100 bond. We see in the top left corner that this bond is paying 8%. It's paying 8%. So 8% of $100 is $8 per year. So given that this is $8 per year, we can see that this is actually paying out $4. Notice these little certificates, these 3 certificates that we have here. These are the interest payments. So what's happened here is I have purchased this bond for $100. I'm going to get an 8% return on this bond, which means I'm going to get $8 per year, or, as we see, $4 every 6 months. And we can see the dates. We've got July 1st, 1841 in the bottom right, July 1st, 1841. And then we have January 1st, 1842. Right? So we're essentially going through every 6 months with these little certificates. So what we do is we rip off each of these little certificates every 6 months, and we get $4. And then at the end of the term, I can actually get my So let's look at the process of redeeming this bond. So what I've done is I've purchased a $100 bond from the government, which means that the government is borrowing $100 from me. And in return for that money, I am going to receive interest payments of $8 per year, 8%. So every 6 months, I'm going to take one of my certificates in and get my $4. You could probably tell that this bond is a 5-year bond. Since I have 10 certificates and I can redeem 2 certificates per year at $4 each. 2 certificates per year, 10 certificates, means that it is a 5-year bond. This means that my total interest payments on lending the government $100 is going to be $40 at the end of this 5 years. So we're entering the last year of interest payments. Another $4 into my pocket. And then I will reach the maturity date of the bond. On the maturity date, I'm going to receive my last interest payment of $4. And I'm also going to be able to redeem the bond and get my initial $100 back. So, this is how a bond works. So we're going to use this bond here as our sample for the next set of, next part of the lesson. This is the case where the government would like to borrow money. So the government can actually send a bond directly to the Bank of Canada. And then the Bank of Canada is going to think about whether or not they want to buy the bond. Usually they're fine with it. So they purchase the bond, and the bond goes into the Bank of Canada. And out of the Bank of Canada comes money, right? So notice how the money supply has increased. So when the Bank of Canada buys something, i.e. a government bond, the money supply increases. They can also do this with foreign currency, right? If they decide to buy foreign currency, we can see that the Canadian money supply is increasing. And of course, if we go in the other direction, if the central bank sells a bond or sells foreign currency, then the money supply in the economy will decrease. What happens if the government wants to borrow money, but the central bank does not want the money supply to increase? Well, if the government wants to borrow money, and the central bank does not want the money supply to increase, they may just say no to the government, or the central bank may engage in a sterilization process. So sterilization is essentially a buy transaction followed up by a sell transaction. And this would keep the money supply constant. Notice in the bottom right corner of our animation here that we have money in the economy. Let's just say that this is the money in the economy and the government would like to get some money, but they don't want to tax people. So they send a bond over to the central bank. The central bank gives them their money to help out the government. But now we've got twice as much money in the economy. And the central bank doesn't want this extra money in the economy, so what they do is they begin to sell foreign currency to get that money out of the economy. So you'll notice that at the beginning of this animation, there was essentially, 2 stacks of money. And then at the end of this animation, there are 2 stacks of money. So the money supply has not changed, but through this process of sterilization, the central bank has been able to get money to the government, and the government is not required at this point, is not needing to raise taxes for the people. So let's get into fractional reserve now. Fractional reserve is the case where banks can create money. Commercial banks can create money. Commercial banks are required to hold only a portion of your money. So if you deposit $100 in the bank, they don't just store $100 in their vaults. They actually take that money and lend it to other people. So the reserve requirement is the minimum amount of money that the central bank, that the commercial bank is required, reserve requirement, is the minimum amount of money that the commercial bank is required to hold. That may be 10%. Now they're going to choose a reserve ratio, which is going to be higher than the requirement. So they may choose a ratio of 12%. I mean, they could choose 10%, but we would see if we did some math that that's not a wise idea. I'm not going to get into the mathematics of that right now, but the reserve requirement is the minimum requirement, and the reserve ratio is what the bank chooses. And that ratio must be equal to or above the requirement. Most banks will choose a ratio which is higher than the requirement. So again, what this does is it allows your commercial bank to lend out your money. And when that money gets lent out, it ultimately becomes a deposit somewhere else. Right? So in that process, essentially another deposit is being made, which means that the deposits is going to go up. And then this other bank in which the deposit was made is only going to keep a fraction and loan out some money, which will get deposited. And then some of that will get loaned out. And then it'll be deposited and loaned out. So this is a repeating cycle. And here we have an example. Here we see that there is a new deposit of $50, and let's just say the reserve ratio is 10%, which means that the reserve requirement must be 10% or lower. The new deposit is $50, and the bank, the commercial bank, is only keeping $5 of it. That's all they have to keep. That's all they've got with their ratio, which means that they lend out $45. And then that $45 becomes a deposit at some other bank, or maybe even the same bank. And of that $45, the bank, the commercial bank, keeps $4.50. They lend out the other $40.50, which becomes a deposit somewhere else. This cycle continues to repeat itself. And ultimately, we find that there are going to be new deposits of $500. Now, this process that we see here is based on, nobody holding currency. All right, so there is no currency drain or cash drain. Everything is deposited. And that's the example that we're going to see here when we talk about the deposit multiplier. So we can use the reserve ratio to calculate the total amount of deposits based on the initial amount of money or deposits put into the bank. So 1 over R is called the deposit multiplier. And M naught is the initial amount of money deposited or basically put into the system. This is the initial amount of money. So we've got a deposit of $50 and a reserve ratio of 10%, meaning that we have 1 divided by 0.1. That gives me a deposit multiplier of 10. I'm going to multiply that by 50. And I can see that the total amount of deposits in this particular system is going to be $500. Now I can tell you right now that the total amount of money in the system is also going to be $500. So in this case, the deposits and the money supply are the same. And they are the same because, again, there is no currency drain or cash drain. Those are words that say the same thing. Currency drain, cash drain, same thing. We can see this in a T account. So those of you who have taken accounting, we can see exactly how it looks on a T account. We've got reserves of $50. We've got loans of $450. And we've got deposits of $500. Right, so the left side, the assets of the bank, are equal to the liabilities. So in the vaults is $50. That's what the bank owns. They have to keep 10% of the deposits. They have lent out $450, which means they are owed $450. That is also considered an asset. And then they owe people $500. They've got depositors. People have deposited $500 in the bank, and the bank owes these people $500. So we can see that both the left side assets and the right side liabilities are equal. Right? This is how balance sheets work. And again, you can learn more about this in accounting. But the important thing is that we can see that this initial deposit of $50 has increased to $500. So the money supply has increased by 10 times because of fractional reserve. And again, the money supply is going to be exactly the same in this case. 1 over R multiplied by the initial amount of money. Reserves do not count as money supply, right? So if it's not in the economy, which means in this case it's in the reserves, that $50 that is kept in the vault of the bank, that is in reserves. That is not part of the money supply. So the money supply is equal to deposits plus currency. So all of the deposits plus the currency that people have in their pocket is the money supply. So in our last example, the money supply and the deposits were exactly the same, which means that nobody was holding on to currency. So let's take a look at the multipliers when we do have a currency or cash drain. First thing we need to do is determine the currency to deposit ratio. Right? Notice the terminology that I am using here. Right? Pay attention to the terms cash drain and currency to deposit ratio. C is the symbol that we use for the currency to deposit ratio. And it is equal to currency divided by deposits. That is the ratio. That's exactly what our ratio is. These are your multiplier equations. So the multiplier, the deposit multiplier, is 1 divided by R plus C, where R is your reserve ratio and C is your currency to deposit ratio. And then we can see that the money supply is equal to 1 plus C over R plus C. All right. At least your money multiplier, I should say, is 1 plus C over R plus C. Notice in this particular equation, when we think about C, which is currency divided by deposits, if nobody holds currency, that means that the amount of currency in the economy is 0. And the amount of deposits in the economy is, 100%. Which means that the currency to deposit ratio would be 0% divided by 100%. C would be 0 in that case. And when we look at these two equations, we see that deposits is equal to 1 over R multiplied by M naught if there is no currency or cash drain. Again, I just told you how C becomes 0. And then if C is equal to 0 for the money supply, well, then that means we again have the money supply equaling 1 over R multiplied by M naught. So that's why when we look back at the simple multiplier, the deposits and the money supply, the multipliers were the same. When there is no cash drain, then the amount of money is the same as the amount of deposits. Imagine that $1,000 of newly created currency is dropped from a helicopter and people gather it up. Everyone holds 20% of the money in currency. The cash drain is 20%. The cash drain is 20%. And they have deposits, which would be the other 80%. Of the money. The bank has a reserve ratio of 15%. Calculate the total deposits and the money supply. First thing we need to do is calculate the currency to deposit ratio. The currency to deposit ratio is 20% divided by 80%. What was the cash drain? 20%. What is the currency to deposit ratio? 25% or 0.25. Pay attention to those terms. Going to our deposits, we see that 1 over R plus C multiplied by M naught is going to give me 1 divided by 0.15 plus 0.25. So my deposit multiplier is 2.5. My deposit multiplier is 2.5. I'm going to multiply that by my initial amount of money, giving me $2,500 worth of deposits. Moving on to the money supply, 1 plus C over R plus C. If we go ahead and do this, of course we see that it is greater than the deposits because the money supply is equal to deposits plus currency. So the money supply is always going to be greater than the deposits unless there is no cash drain. The deposits can never be greater than the money supply. At best, money supply and deposits would be equal. Again, only if there is no cash drain. We're going to go on and do a little bit more math. I want to know, can we use the multipliers only, to calculate the cash drain? Confirming our answers. What are we calculating? The cash drain, not the currency to deposit multiplier. So, we know that the cash drain is 20%. Can we use the multipliers to do anything? Sure. We know that the percent of deposits is going to be all of your deposits divided by all of your money. 2.5 was my multiplier for deposits. 3.125 was my multiplier for cash. For money supply. 2.5 was my multiplier for deposits. 3.125 was my multiplier for the money supply. So, deposits divided by money supply is going to give me my percent of the money that is in deposits. And it tells me that it's 80%. And if that is the amount of money that is in deposits, then that means that the percent that is in cash must be 20%. So I have shown that my values for the multipliers must be right. So the money supply or the money control is not perfect. We saw that the Central Bank of Canada is capable or is able to control the money supply fairly well. But then we also saw at the end that there are two factors that the central bank is not fully in control of. So yes, they can set a reserve requirement. However, the commercial banks will set the reserve ratio. And we see that the households can hold or not hold their cash. How much cash are you going to hold? 20%? 1%? 50%? How much of your money that you have are you going to hold in cash? So these two choices mean that the money control, or that the central bank's ability to control money, is not perfect. Right? It's good. I mean, they can do a pretty good job of controlling the money, but they cannot control it perfectly. So we'll finish off with a description of the bank run. This has happened in the past. If you read in your book, you'll see that during the the Great Depression back in the 1930s and 40s, during that Great Depression, that a lot of people in America, as well as other places, they had bank runs, which means that everybody is running to the bank to withdraw their money. They want their deposits. Well, taking a look at our T account, you have a lot of people going into this bank trying to get their deposits back. Hey, give me my $500. And then the bank is saying, well, we only have $50 of your money. So you see that fractional reserve, it does work when the economy is stable, because most people, or essentially people don't all go to the bank to withdraw all of their money all at once. That never happens. I mean, I haven't been to the bank machine in over a week. So we don't all go at once to withdraw all of our money. So fractional reserve is able to work. But if there is some sort of crisis and people get scared, they might want to run to the bank and withdraw all of their deposits. Well, the banks don't have it. They only have $50. So, we learned that money has three main functions. We learned that the central bank is in charge of a nation's money. And we learned that fractional reserve is a way that commercial banks can create money. So I'd like to thank some of the websites that had photos and pictures, animations that I ended up using. Thanks for tuning into this lecture. And we'll see you here next time.